Central banks are quietly reshaping the global economy, and most people have no idea what is happening behind the scenes. Over the next few days, the world's most powerful central banks, the US Federal Reserve, the European Central Bank, the Bank of England, and the Bank of Japan, are all making big decisions on interest rates. These moves will influence everything from your mortgage rate to your job prospects to the value of your currency. In this video, let's calmly break down what this central bank super week really means, and how the different choices in Washington, London, Frankfurt, Tokyo, and even Beijing are setting up a new kind of global financial order. The first big story is the United States and the United Kingdom slowly stepping on the brake. After 2 years of aggressive tightening to control inflation, the US Federal Reserve has begun cutting interest rates again as growth cools and the job market softens. The Bank of England is expected to follow with its own rate cut, worried that the British economy is flirting with stagnation, even though inflation is still above target. On the surface, rate cuts sound like good news. Cheaper borrowing, some relief for households and businesses, and a softer landing instead of a hard recession. But there is a tension here. Cut too slowly, and economies could slip into recession. Cut too quickly, and inflation could flare up again. Europe and Japan, however, are not following the same script. The European Central Bank is choosing to sit still, keeping rates on hold and signaling that it prefers stability over big moves for now. The Eurozone economy is weak, but not collapsing, and inflation has mostly come back toward its target, so the ECB is wary of sending the wrong signal. Japan is doing the opposite of the US and UK. After decades of ultra-low rates, the Bank of Japan is preparing to raise interest rates again as wages rise and inflation finally looks more durable. That is a historic shift for Japan, and it has huge implications for global investors who have used cheap Japanese money for years to fund risky bets around the world. Meanwhile, in the background, China is fighting a very different enemy: deflation. Instead of worrying about prices rising too fast, Beijing is worried about prices falling for factory goods, exports, and sometimes even for consumer items. That might sound nice, but deflation can be toxic for an economy. When companies earn less for what they sell, they invest less, hire less, and may even cut wages. Consumers delay spending because they expect things to be cheaper tomorrow. To keep its huge industrial machine running, China is pushing more cheap goods, from electric vehicles to solar panels, into the global market. That helps keep inflation in the West lower, but it also fuels trade tensions and accusations of dumping. Put all of this together, and you get what many analysts are calling a new era of monetary divergence. The US and UK are gently easing, Europe is holding steady, Japan is tightening, and China is stimulating in its own way. These differences create powerful waves in global markets. Capital tends to flow toward the places with higher real returns and perceived safety. If US rates fall while Japanese and European yields look more attractive, some money will leave US assets and move into other markets. Exchange rates shift. The dollar can weaken, the yen can strengthen, and those moves affect trade balances, corporate profits, and even geopolitical leverage. In other words, interest rate decisions are not just about economics, they are about power. For ordinary people, this divergence will show up slowly but clearly. Borrowing costs in some countries will ease, while in others they will stay high or even rise. Stock markets that were driven by cheap money and technology hype may become more volatile as global liquidity changes direction. Countries with high debts will feel more pressure if their funding costs stay elevated while growth remains weak. At the same time, cheaper Chinese exports and shifting currencies will shape what you pay for cars, electronics, energy, and food. Understanding this central bank super week is really about understanding where the next phase of the global cycle is headed. Who will grow, who will struggle, and who will quietly gain influence as money moves across borders. If you found this explanation helpful, and you want more calm, in-depth breakdowns of geopolitics, economics, and global markets, make sure to support the channel. Please like this video, leave a comment with the topic you want decoded next, and don't forget to subscribe to Macro Decoded so you never miss an update. Your support helps this channel keep making complex global stories simple and accessible for everyone.